As mortgage rates continue to climb, home builders are offering bigger and bigger incentives. The two most attractive offers I'm seeing right now are they're either offering a crazy low mortgage rate, usually 2 to 3% below the market mortgage rate, or they're offering a big sum of flex cash, which is just a dollar amount that can be used either to reduce the purchase price, pay down your closing costs, buy down some interest, however you'd like. But which of these is actually the best option for you? I'll tell you, most of my buyers are usually really attracted to the lower rate for the obvious reason of getting a lower monthly payment. But in this video, I'm going to explain just how these incentives work, why it's probably not as straightforward as you think, and why I think you're probably actually better off going with a builder offering flex cash in the form of a price reduction compared to the builder giving low mortgage rates. And I'm also going to walk through a real life example looking at a real neighborhood here, two builders where one is offering flex cash, one is offering a low rate. And I'm going to show you real numbers and exactly how all of this works. So if you're considering buying new construction and taking a low rate, make sure and watch this entire video so you don't get trapped in a bad deal, and at the very least, you're fully informed about what exactly you're choosing. My name is Michael. I own a local real estate brokerage here in the Dallas area. And if you're looking to buy or sell in the Dallas area, I'd love to connect. I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that info is in the description below. Okay, in this video, I'm looking at two similarly priced homes in the exact same neighborhood from two different builders, one of which is offering a 5.99 rate, the other which is offering $30K flex cash. First of all, how are these builders offering such a low rate? Well, they're not just giving it to you for free because they're your friend. The long story short is they're selling you the home at a higher price, then they're using that extra cash to either buy down the mortgage rate on the back end and or offset the losses their mortgage company will be taking. For example, if a builder is offering a 2% lower mortgage rate than the market, which is about what most of them are offering right now, that lender will then have to go and sell that loan at as much as a 6 or 8% discount or loss. And if the builder is offering a 3% reduction, their loss on that loan could be as high as 12%. Now, to better understand this, let's first take a look at how mortgage lenders make their money in the first place. Mortgage lenders originate and then sell their loans to the secondary market at a premium for more than the amount of the promissory note. For example, a lender might sell a $100,000 loan on the secondary market for a 2% premium, meaning they sold that loan for $102,000. But in the case of these builders originating loans with low rates, they then have to go and sell these loans at a discount. So selling the loan at an 8% discount because they gave you a 2% lower mortgage rate on a $100,000 loan would mean they sold it for only $92,000. So the builder's mortgage company takes an $8,000 loss on that loan. Unless, of course, you, the borrower, are paying that amount up front, which is pretty much what's happening. So let's look at some more realistic numbers. You want to buy a nice new home for $525,000. You're putting 5% down, so your loan amount is $500,000. This builder is offering you a 5.99% mortgage rate compared to the market 7.99%. So they're giving you a 2% lower mortgage rate. The builder's lender is going to originate your $500,000 loan and then sell it on the secondary market at an 8% discount. So they're selling your $500,000 loan for just $460,000 at a $40,000 loss. But in reality, the builder is actually charging you $40,000 more for the home by raising the purchase price. And you might say, well, doesn't this make it look like the builder's lending company is losing money, and wouldn't that scare away investors? Well, no, because the lending arm is owned by the parent company, so the overall company didn't lose any money at all. While the mortgage side loses $40K, the build side made an additional $40K, meaning the low rate was free, paid for by you, and all the while they got to sell another house and lock in some profit, which of course is good for business, which of course brings more investors. Now, I know that was a lot, so if this is your first time hearing something like this, feel free to go back and watch it again. Make sure you understand it before we move on. Okay, now let's look at the other builder, which is offering $30K in flex cash. This is money from the builder that you can use however you'd like. And a side note to this, there are some builders that will only allow you to use a certain portion of this flex cash for a price reduction, and the rest you'd have to use on closing costs or buying down your rate. For example, if they're giving $30K flex cash, they may say only $15K can be used for a price reduction. The other $15K you have to spend on closing costs, buying down your rate. This is because builders always want to keep their prices as high as possible. The last thing builders want is for their prices to come down. They're way better off spending $40K to buy down your rate than dropping prices in their entire community by 540K. This is because they know that these high mortgage rates are just temporary. And in the next year or two, rates are going to be coming right back down. And when they finally do, there's going to be plenty of demand to sell at their top prices. So if they can just keep their prices high through this season, they know down the road they'll be able to sell at these prices without giving any incentives, because there will be plenty of demand when rates are back at 6% or lower. Do you see what I'm saying? For builders, it's really just a waiting game right now. They're just thinking, how can we keep our prices high until rates come down again? So again, they absolutely would rather you take the high price, low rate, because then it makes the community look like they all sold for this high price, so it'll be easier to continue selling at that price in the future. But in our example, this particular builder actually is allowing the full 30K to be used for a price reduction if you so choose. And in a minute, we'll go through an example covering actual numbers for both of these homes. But quickly, I want to cover two key upsides to taking the price reduction over the low rate. The downside is obviously you're going to have a higher monthly payment out the gate. But the upsides are, one, there is a very high chance in the next few years you'll be able to refinance down to that same 6% rate they're offering now. So can you imagine if 2 years from now you got your house for 30K less than all your neighbors, and rates come down to 6 and you're able to refinance? This is a pretty likely scenario in my opinion. I think it's very likely you could have the best of both worlds by taking the price reduction today and hoping for a refinance in the next few years. The second major upside is resale. This is something a lot of buyers don't consider because the monthly payment weighs so heavily on their minds. If you can save $300, $400, $500 a month today, you're not as likely to care about how am I going to sell this house 3 to 5 years from now. But the reality is, in order to sell your home, just to break even, you're going to need home prices to appreciate 6 to 7%. Just to break even, because selling a home is expensive, which also means you'll need the home builder's prices to appreciate quite a bit more than that 6 to 7%, because it's likely that home builder is still going to be your competition a few years from now. So these future buyers are going to be weighing your 3-year-old home versus whatever the price of your same exact floor plan is selling for at that time. So using our example of a 525K home, you'd have to sell it for a minimum 556K just to break even if you took the low rate. However, if you took the 30K discount up front, then you purchase the home for just 495K, and for you to break even, you only need to sell the home for 525K. So all your neighbors who took the low rate will have to list their home at least 556K to break even. Meanwhile, you would only have to list your home at their original purchase price of 525K. So you're going to be way more protected than they are if you ever need to sell this home. You don't need the market to appreciate even $1. You literally just need home prices to remain right at the price that all of your neighbors bought them at. Now that's peace of mind. Okay, let's move on to our real life example. We have two homes. They're in the exact same neighborhood. They're at similar price points. Let's take a look at some pictures. This is home one. It's listed at 569K. They're offering a 5.99% rate. It's a perfectly nice home. The spaces look a little bit smaller than you might want, but we're not going to look at the whole house. I just want you to get an idea of these two houses, that they have similar finishes. Okay, here we have home number 2. This home is listed at $540,000 and offering $30K that can be used as a price reduction. So we're going to be buying this for $510K. Here's what it looks like. In my opinion, it's a nicer home. It's 2 stories and it's 412 square feet larger. So it has a whole second floor area, and overall the spaces just feel bigger as well. Look at this. Vaulted ceilings throughout the entire house. Look at the size of that living room compared to the last one. Much larger. It has an extra window, so a lot more natural light. This is a huge bedroom. I don't think I showed a bedroom of the last one, but just overall, it's a much larger house, and the vaulted ceilings make it feel even larger. And as you can see, the finishes are pretty comparable. The bathrooms look very similar as well. Okay, let's take a look at these numbers side by side. Home number 1 is here on the left. That is at $569K. We're assuming 5% down on both of these houses as well. But $569K with a 5.99% rate brings you to an estimated $4,734 a month, whereas home 2 with the higher rate but much lower purchase price is only $165 a month more than home 1. And remember, this is 400 something square feet larger. You're getting a discount on the purchase price, and you have the opportunity down the road to refinance potentially to that same 5.99% rate. And something you'll notice about home 1 is because it has that higher purchase price, the mortgage insurance is going to be higher, the insurance is probably a little higher, and the taxes are higher as well. So even though your principal and interest is quite a bit lower, everything else goes up because your purchase price is higher, and those things are calculated usually on the purchase price. So this to me is a no-brainer. The higher rate home is nicer, Larger, it's $59,000 cheaper, and it's only $165 a month more. But let's take it a step further and say you took the low price, and in 2 years from now, you're able to refinance down to that same 5.99% rate. Then how do these numbers stack up? Well, check this out. Then Home2, the much lower purchase price, now has the equal rate, and your monthly payment is only $4,249. So your home is now $485 a month less than all the other buyers who took the higher price home at a low rate. Meanwhile, rates have dropped 2%, and it doesn't benefit any of those other buyers at all. They're still stuck at their $4,734 a month payment while everyone else is refinancing and having a great time. Now, I also want to clarify something. I am not saying that you should never take the low rate. Not every neighborhood has this exact scenario. And for some of you, it may seem like taking the low rate is the only way you can even afford a house. If that's how you feel, please give me a call and let's talk through your situation. There is no one-size-fits-all answer for everyone, but in this video, I just wanted to provide some context to consider before being sucked in by these low rates. And also, in some communities, taking the lower rate could mean savings of anywhere from $500 to $800 a month or more. And that may be a strategy you use to get into your dream home. $800 a month will get you more than an extra $100,000 worth of house. So if $600K was the top of your budget, you'd be able to upgrade to a $700K plus home by taking the lower rate for the same monthly payment. And for you, this may be the difference between settling on a 4-bedroom home that's good enough for a few years versus getting your dream 5-bedroom home that you can stay in for the rest of your life. So in that case, the low rate might be a great idea. So there is no judgment from me at all. My goal here is simply to inform as many buyers as possible to make sure that you are all able to make the best fully informed decision for you. And if you're not looking for new construction because you just don't want to be out in the suburbs, there are still plenty of ways to get your monthly payment down to an affordable range, and I cover all of that in this video here. So if you're interested, give it a watch. If you got any value from this video, please give it a thumbs up so that more people can see it. Share it with your friends and loved ones. And as always, if you're looking to buy or sell in the Dallas area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that info is in the description below. Thank you for watching. I'll see you in the next video.